Hi, this is Francisco, and welcome to Forex Academy. Today we are going to discuss the Williams %R scalper strategy. Let's begin. Williams %R is a momentum indicator developed by Larry Williams, which is similar to the stochastic indicator. The Williams %R shows the position of the close in relation to the highest high of the period. The formula is -100 multiplied by period high minus close divided by period high minus period low. Therefore, this oscillator moves from -100 to 0. Values below -80 are oversold levels, while values from -20 to 0 are overbought. The best period to use in intraday trading is the 10-day period that reflects the position of prices in relation to the 10-period high. When the %R signal gets into the higher band between -20 and 0, it's a sign of overbought prices, because price is close to the recent 10-period high. When it moves into the lower band from -80 to -100, prices are oversold, because it is quite far away from the recent 10-period high and very close to the recent 10-period low. This alone, or in combination with a trending filter, is a terrific way to spot market turns with high probability of success. Intraday trading is a dangerous profession. More than 85% of traders fail because they buy when they should sell and sell when they should buy. Williams %R is an excellent tool to do the right thing and buy cheap and sell high. To those new to mean reverting markets, please welcome the Williams %R system. And these are the rules. For long entries: 1. Wait for the 10-period %R line to enter the oversold territory between -80 and -100. Go long the next candle whose %R line is above -60. Handle your trade using a trailing stop of about 0.3%. Let it run until the %R reaches overbought, and then tighten your trail stop, but let the market take you out. For short entries: wait for the 10-period %R line to enter the overbought territory between -20 and 0. Go short the next candle whose %R line is below -30. Handle your trading using a trailing stop of about 0.3%. Let it run until the %R reaches oversold, then tighten your trail stop, but let the market take you out. We use the 10-period Williams %R signal, as stated in the rules, on a 0.3% trail stop, using 13 years of 1-hour data of the Euro-US dollar. This is the equity curve using a constant one-lot size. This is the standard way to assess the quality of the system. The important parameter here is not the amount won, but the statistical characteristics of the curve and the smoothness. We made a test also on this system using a proportional 1.5% risk sizing strategy, and it delivers close to 4 million euro along 14 years, with about 35% drawdown. In the case of a one-lot contract, the drawdown is just 7%. The table shows the total trade analysis for the system. The percentage of profitable trades is very good, with an overall 48.11% of positive trades. The ratio win-loss that measures the reward we get for the risk we hold is not spectacular, but it's fairly good on a system with no filter to allow only trades in the primary trend. It shows a healthy 1.55 ratio, and this is fantastic on a system that has close to 50% winners. On this shuffled Monte Carlo analysis, all trades are exactly the same on all paths. The only difference is that the shuffling changes its order. This allows us to observe the possible histories. The original trajectory is the green one, while the blue history experienced the lowest risk, about 5%, and the brown was one of the most wild ones, with the largest drawdown of the set at 50%. That shows that although the chance is remote, there is a tiny probability that we may experience extreme drawdowns. The total trade analysis shows a mean profit after 14 years of about 50,000 euro using a constant lot size. When we simulated the strategy using a trade size of 1.5% of the balance on 1 hour chart, we obtained a final equity of 4 million euro. The average trade analysis shows a healthy average trade between 40 and 60 euros using one lot size. That's a healthy figure. If we manage to get 5 trades a day, it could be a daily income of 300 euros, which results in 6,000 euros monthly trading on a single lot. The max drawdown analysis graph shows that the most likely figure for drawdown is between 7,000 and 11,000 euro, although a small chance exists that the drawdown may reach 16,000 euro. The max losing streak analysis tells us that we need to be prepared to endure up to 14 losers in a row, although the most probable situation is for drawdown streak to be below 10. This figure is much better than most trend-following strategies and allows us to increase our risk to maximize our profit. This is just an example to show you the link between position size, drawdown, and losing streak protection. The concept is easy. We want to be protected against 33% drawdown, and we expect that at some point we will get 15 consecutive losers. Therefore, we just divide 33% drawdown by 15. So we conclude that we cannot trade using more than 2.2% risk of our trading balance, or about 22 euro every 1,000 euro in our balance. Then our maximum dollar risk from entry to exit should be below that quantity. For instance, if the risk on a trade is 50 euros per lot and we have 1,000 euro balance, then the maximum size to trade will be 4 lots. This is not meant to teach math, therefore we'll keep math to a minimum needed to understand the concept of diversification. To understand the power of diversification, we assume that we are able to find a basket of totally uncorrelated assets. In that case, the total risk of the basket is computed by the formula above. Total risk squared is the sum of the weights on every asset multiplied by its risk squared. For the special case where weights and risk are identical, total risk squared is equal to n, the number of assets in our basket, multiplied by r squared, the risk in every asset. For a basket of 5 assets, this means total risk is the square root of 5 multiplied by the individual risk r, or total risk is equal to 2.23 multiplied by individual risk r. Therefore, a basket of 5 assets combined have less than 50% the risk of a 5R position in one asset. Therefore, it is wise to have a basket of uncorrelated assets to reduce risk. Okay, let's see how to install the Williams percent indicator and how to trade with it. Okay, insert indicators, oscillators, and our Williams percent range. And okay, here we set the period then, and we can change the color. Okay, it could be every color we want. And let's say, let's use it a little bit more wide. Okay, this is the Williams percent R. So we are now ready to trade using the Williams percent R strategy. We observe that oversold conditions, getting out of that area is a nice place to trade. So around this place matches the getting out of this oversold area. So we go straight up, as you see, and maybe our our trail stop get us out around this point for a very nice trade on the long side. Then we see that this comes down, and this should match. This should match. Okay, yeah, around this place. So we sell short just around here. We sell short, and of course we should cover in this place, so we are not taking out from the trade, and we traveled up to this point, which is, let's see, okay, this is the point. For yet another good trade. And getting out of that point is of course this place. We go straight there for a scratch or something like that. To sell again. Around this place. And we could also buy and get a small gain here and sell and get also a small gain here and buy and get also a small gain here and sell. Okay, here we buy, but we get nothing or even we lose. Again, we buy around here for a scratch. We sell here for maybe a small gain. We buy here for a nice gain. We sell here for a scratch or something like that. And we buy here for a very nice prolonged gain. Maybe the trail stop take us out around this place because this is a channel. And we sell to get down here, and then we buy to get for a nice, very nice gain, and we get out around this place for because this is our trail stop that takes us out. We sell, and we see that again we get out of the place. So here we sell a little bit, we lose a little bit, and we sell here again. To get out around here, and so on. So this is how to trade the percent R. You can see that that is very easy to position to where the market should go. This is it. Till next time.